Welcome to the 1% Pathway podcast. I'm your host, Dennis McQueen of MCQ Properties. I talk with leading real estate industry experts to explore how they are building serious wealth through real estate so that you, our listeners, can learn, model, and do the same. Let's jump in. Today on the podcast, we're discussing the truth behind preferred returns. Our guest today is Selcuk Alemdar, who's a principal with Ephesus Equity Partners. Selcuk is a seasoned real estate investor with a diverse background. He has degrees in both geological engineering and construction management, giving him a unique analytical perspective on properties and projects. He's got a portfolio of over 1,400 doors, including 310 as a general partner, and he has a proven track record of identifying high-value opportunities that deliver robust returns for his investors. And he has both invested in and offered deals that have preferred returns, which makes him a great source for today's topic, the truth behind those preferred numbers. He's here to give us a clear, grounded back look into what really matters behind those hidden figures. Welcome to the show, Selcuk. Can you start by telling our listeners a little bit more about yourself and what you do?
Sure. Yeah. Hello, Dennis. Thank you for having me on this show.
Great to have you.
My name is Selcuk Alemdar again, and my background is, you just mentioned a little bit, I'm a geology engineer and have a construction management degree, and I started my career as a site manager for a construction company and working on residential and office buildings, where I was involved in the project management and estimating. And then after that, I became a manager for a batching plant company for 4 years. We were producing, ready-mix concrete and all that. Mm-hmm. And I was responsible for production, quality, and control of sales, basically. And that real quick, throughout my career, I always had an ambition to start my own business. And given my background in construction, I was naturally drawn to real estate investment. Mm. But then the 2008 real estate crash happened. So as many of your listeners might remember, the market was essentially dead for a couple of years. You remember that too. So, and I decided I needed to do something more like a recession resistant. So my business partner and I, we ended up buying a gas station in Eastern Washington area. So, and I had to stay away from real estate a little bit and construction because literally there was no jobs, no business, period. Mm. And in the buying this business, my thinking was simple, like everyone still need gas and beer and chips, right? So
sounds easy,
it felt
right?
like a much more stable business for that economic climate. And long story short, after a few years, when the real estate market began to recover, and I saw my opportunity and decided to start my second business, which is this multifamily real estate investments.
That's a great story. Thanks for sharing that. And it sounds like you had a lot of ups and downs, as everybody does. What kept you going when things got hard? Just persistence, or?
So, try to keep. That's my principle. Whatever I do, I try to keep my motivation as high as possible. Right, mm-hmm. Motivation is the key to everything. And to me, there's a direct relation between having high motivation and keeping a big gap between the gain and loss. Mm-hmm. So the higher the gap, the bigger the motivation. Yep. And I've been in the business world for over 25 years, and what I've learned is that the growth is hidden in finding effective solutions when things get hard. Mm-hmm. So basically, to me,
hanging on to them, right?
Hanging on to them. The preparation is the key. And when I start any project, I try to imagine as many potential problems as possible up front. So some might say that it's a negative approach, but it is not. It's a projection of upcoming challenges.
I love the way you say that. Yeah. And as you're describing that, the word picture that comes into my mind, and you can relate to this with your experiences, when they're building a tall building, people get caught up in the building when it's done and it's pretty, but they needed to see the foundation being built and poured, and how deep that concrete and rebar goes, and the taller the building, the deeper the foundation needs to be. Without it, that building's falling, right? And a lot of people miss that. And that's as you were describing what you did, that's what came to me. And a lot of people just don't want to do the work to build that foundation, right?
Yeah. And there's tons of things around us that can, out of our control, that can bring those challenges. Let's say the real estate business is a teamwork, and a team can have many members, and plus you have your tenants and vendors and unexpected market events, and all of these can bring a lot of challenges, and you got to be prepared for it
and respond. That's great. Thanks for sharing that. Let's dive into our core topic here about these preferred returns. We see a lot of sponsors touting those, and do you see any specific market or asset level trends that are making these irrelevant without a strong cash flow?
So lately, I'm very interested in this different class assets,
different asset classes.
Different asset classes. That is assisted living. Real estate.
I've heard a lot about that. Yeah, I haven't dug into it a lot. Please continue.
So that's a significant trend, especially last couple of decades, and the stats shows that's like by 2030, which is around the corner, and there will be an estimated 73 million baby boomers in the United States. That's crazy.
It's that tail end. The baby boomers are aging. I'm on the tail end of that generation myself, so I understand what you're saying. Yeah. It's like the rat going through the snake, right? Yeah,
exactly. And I don't see that asset type properly conceptualized in the same way as the apartment complex is done. So, besides the returns, first of all, let's say this first. We need to take care of our seniors, right? So that's the human thing first. And a large portion of them can no longer live safely or comfortably by themselves in their homes, and they need assistance. And their children often cannot really provide the level of professional care that's required. And I've been working on a new models. It's actually a lot of people started doing it. Some people, some investors, so to speak, they do like an apartment complex type, and some do like really like the 5, 6, 7 the room, single family house type of thing. But I've been working on a new model that make them feel like they still living in their own house, but on a slightly bigger scale. Like this is a 32 unit model. It's like 16 unit the assisted living, and the 16 unit like memory care. And this is like mostly one-story building with the option for a second floor. So that includes recreational area, the large restaurant-style dining area, a commercial kitchen, a game room, a hair salon, and a patio, among the other amenities.
And if I'm understanding you right, the cash flows in those type of investments are higher than most multifamilies because you've got all these services. So those higher cash flows are what can really sustain a preferred return. Whereas some of these others, they're just throwing a preferred on there to get people interested. I mean, do you have a painful lesson from the past where maybe you saw a high return being touted, but then as you looked at the underwriting, the lack of operating cash really wasn't there? Or maybe you haven't.
Just like you're doing any other business, right? So you have to have more profit centers in your business. So if it gets one of them, it gets trouble, and then the other one can cover it a little bit to help it. So on the regular apartment complexes, it's great. We're still doing it. I'm not minimizing anything because we need those too, right? And but to this type of business, you can put a little bit more the profit centers, and then it makes the return a little bit bigger.
Yeah, there's more. I
And
know that when we talk, sorry, I interrupted real quick.
no, no, no.
But as you're saying that, what popped into my mind is with classic multifamily value add, we're always looking for what are some upsides? Is it, I mean, the utilities you always build back, obviously, but then there's, can we do covered parking? Can we offer storage and package delivery? Can we offer
Mhm.
other amenities, right? And depending on the location and the clientele, people are willing to pay for some of those things. And the assisted living, it's like that on steroids almost, right?
Yeah,
Yeah.
yeah. It's a little bit heavier to operate that, obviously, because it's just like a more professionals
Right.
involved in that and all that. But it just whatever you put in more, and then you get more. You get out of
Right.
more on that. So, and also with this model, real quick, that's important. And the separate on the same lot, same land, there's a separate model too. It's called independent living. So it can go up to 12, 24 units, this model. So
Hmm.
basically, these residents may only need limited assistance for a time being, like just
Right.
a meal and the cleaning services. But down the road, if their needs change, well, they can smoothly transfer to the assisted living section in the same facility.
Yeah, I've
And so
seen some of
this,
those
mhm,
as my parents
yeah,
aged. They started in what would be considered
mhm,
independent living, then they moved into assisted, and then eventually classical nursing home care because they needed extra help, right? But it was
yeah,
all
yeah,
well, they did make one change in there, but it was very easy. Move down the hall or move to the next wing kind of thing because it was a different skill set maybe on the provider side, that kind of thing.
yeah,
Do
yeah.
you have a mental model that you like to use to get past like the headline of a preferred return number and get really focused on the fundamental health of the asset's cash flow? Is it
Well,
just
it's
looking at the
actually
underwriting, or is there more than that? Or
well, that is like you gotta. I mean, you gotta stick what you're, what you do, what kind of underwriting you're doing, right?
hmm
And it's like almost like a non-negotiable thing. It just you don't want to compromise your target returns and when underwriting a deal. And it's really easy to get emotional with the property,
hmm
and then but you should underwrite the deal with a specific, determine a timeline and a target for your expected returns. Never lower your bar, and don't compromise on that. So even it takes like underwriting like 100 deals to just buy one, you have to stick with that.
Yeah, I'm so
So
glad you said that because I think that's where a lot of people fail is they've got FOMO, their fear of missing out on a deal. They just want a deal, right? And then they,
mhm.
even if they were smart enough to have set a buy box and a targeted return, say it's 20% IRR, just for example, um,
Mhm.
and they're struggling to find that. But they see one at 18, right? Oh, it's close. I'll go get it. Right? It's like, well, be careful what you're doing. That might be okay, but stick to your guns. The
Yeah.
20% and better are out there. Do your homework, and
Mhm.
you'll
Mhm.
find them. I learned that by looking at lots of LP deals and doing lots of underwriting. And
Mhm.
it's the old funnel effect, right? You got
Yeah.
100 to find 10, you might really go into detail to find five that you might submit an offer to get one deal that you get to do. That it's that kind of a thing. And
Yeah. Yeah.
if you're not willing to do that, then this is probably not what you should be doing, right? Um,
Yeah. Mhm.
yeah. Um,
Yeah. Well,
oh,
good.
kind of a spin-off of that. What do you think is the most important thing a sponsor must be able to show LPs that to prove that their promised pref return is really grounded in reality? I mean, it starts with underwriting, but um, anything else you would add there?
Yeah, I would add this. So when you working on a deals to pick one, right? It's not just like a numbers. Obviously, what what's going on around that, the property, location wise and market wise,
Hmm.
and that makes the demand, and demand makes the values, right? And you have to start with the solid market research, and you want to take a look at around the local, economic indicators
Comps and
and
stuff. Yeah,
comps
yeah.
and Yeah, comes more than this is the way I see it. It's just like what's the population growth last the 10 to 15 years? What is
Hmm.
the job growth, and what is median household income? It's growing. Last 10 years is it like a
Hmm.
trend up? And so what is the crime index on it?
Yeah,
And
that's always an important
do
one.
you see a workforce around it? Because
Hmm.
we're talking about apartment complex, multifamily, right? And is the city, even city invest in its own city? And are they
Right.
building something, subway or highway? And these are like, that again, that drives demand. And when there's demand and there's more value, and always, that's what I would do. Always, I consider the risk factors, right? There's
Hmm.
some good stuff going on, but we're projecting at least for 5 years. So, what are the risk factors potentially might come up,
Yeah,
and
I'm
how we can
glad you said.
prevent them?
Right, because there's going to be some, and if you're
Mhm,
looking at a deal and the sponsor doesn't highlight any of them, I'm crossing them out
mhm,
because
yeah,
they aren't being realistic. But to your point, what are the risks, and then what's the plan to mitigate them? And a
mhm,
team with a good track record and a good success record will know that. Well, they'll be open to that, and they'll know, oh yeah, this is typical for this kind of a deal. This is the way that it's mitigated successfully. This is what we're going to do if this
mhm,
happens, or
mhm,
that type of
mhm.
thing. And the best ones I've seen is just they're upfront about it. And so to
Yeah.
me, that gives me a good sense of, okay, these people know what they're doing. Um,
Mhm,
they've got a good plan, not just in standard operations, but when stuff goes south, which it always does, um, somewhere along the line. Well, I shouldn't say always, it usually does. Um, Here's
mhm,
what we've got in place to go fix it. To me, my confidence in that team's a lot higher. And if they've got a pref, I'm thinking, well, these guys, there's some solid confidence in the fact that they've got this well underwritten. Um,
mhm,
I
mhm.
mean, I'm repeating back some of what you said, but to me, that's the stew that has to get cooked, I think, to make it worthwhile. Um,
Mhm, mhm.
on the converse of that, for some new people that are trying to break into some of these, what do you think the most common mistake is? I mean, one of them would be not identifying some of these risks, but are there any other big mistakes people make in underwriting, you think that,
Well,
um,
yeah, so basically on the right, what they get emotional, like I said, with the
yeah,
property. You don't want to get emotional with the property. It just we that's a bad habit we got from when
they
we
fall in
buy the
love with
old
it?
single family houses,
Yeah.
right? So
Okay.
we imagine ourselves in the places and all that stuff. But
Mm,
this is just a tool that can bring you and your investor a return. That's it. And and once you're done with the due diligence and you're ready to make an offer, and it just still continues, right? So you locate
mhm.
the good one, you think, and okay, this property can to bring some good returns and good appreciation, all that stuff. But until the end, you have to follow through your strategy. So basically,
Mhm.
you're gonna inspect the property because you don't know what's lays behind those walls and underground and all that
Right.
stuff. And this is some of the investors were the general partners basically who's putting this together. So sometimes they don't even game plan.
Right.
So this is just like a complete package deal. And if you're not ready for the second step, and then sometimes they feel like they sent the letter of intent, to the seller, and then if you start to think like, oh, what if they accept? What then? And then you're in the wrong mindset. So you're
Right.
gonna have
You want them to
we've seen
accept.
those too. We've
Yeah,
seen.
I have. Yeah.
I was scared. I was scared before we were making a offer on the one property we pick, and I mean, just before you make it, then you have to have a full plan is ready to go, and then
Yeah. Are we in? Are we really in?
Yeah, really. And then as soon as they accept it, you have to start with the inspection right away. You have
Oh
to have a
yeah, you got to
crew.
move. You got to move.
You have the crew ready to go. And you
Yeah.
have to have your local lawyer that can work with you on the, making a purchase sales agreement and all that. The items on it is so important. If things go south during the, inspection period, and then you don't want to lose your earnest money. So,
Right.
so and again, you got to be really strategically prepared for everything until the close, right? And then obviously you have to do the asset management, and then you have to have a property management team already line up for that too, because you're going to get a lot of useful information from them as well, because they're local. They know
Right.
what's going on around the market.
Right.
So, but
Yeah,
overall,
pictures can be misleading. You got
yeah,
to go
yeah,
touch and feel.
definitely,
Yeah.
exactly,
Wow, those are great
yeah,
insights, man. Very great insights. And as we've been talking through this, and we could go on for a long time with this, but we're kind of running out of time. So I'm going to try to wrap this up here. Before I do, one comment and then a couple other questions is, as we're talking through this, the other picture that came into my mind is it really, you said it earlier, it's a team sport. It comes back to who do you have on the team? What expertise are they bringing? What experience and success do they bring to the table? And the more of that you have, the more confidence you can have in how is that team's executing. So when for people listening here, it's all about I encourage people to start as a passive investor first, before they ever consider to try to take a deal on for themselves. And part of that is learning how the whole thing operates and finding teams that are successful. I mean, you've got to go vet sponsors before you invest in them, and you'll find good ones and bad ones, but you'll find teams that demonstrate good track records. And when you find those, stick with it. And then they're going to be able to be the ones that bring these returns and can justify like these pref returns where others are just throwing numbers out there, that kind of thing. But so great stuff. Before we close out, just a couple other general questions. One, do you have a favorite book or like a real estate or mental mindset book that you would suggest to our listeners?
It was actually back in years. One of the first book that I read was The ABC of Real Estate Investing. It's
I've not heard of that one.
by Ken McElroy.
Ken McElroy?
Yeah.
Okay,
Yeah,
I
Ken
know
McElroy,
Ken.
yeah.
I'll have to get that one. I haven't read that one. Okay.
Yeah. So it's
That's
an
a good
old
one.
one, but it's got basics on it.
Yeah.
And
Well,
it's
he's
still
straightforward.
effective today.
He's very straightforward too. Yeah, that's a good suggestion. Thank you. Kind of similar to that. What's the best piece of advice you've ever received?
Well, you know what? The advice you gave to myself. I mean, it is just every single day is a loss. Investing your future if you take no action. So basically, I'm focused on daily basis, right? So day goes by so fast. And then if you're not taking action every single day, it's a loss.
You're going backwards. Yeah, absolutely. Good point.
Yeah.
One last question, and we'll close out here. This has been great. Thank you for doing this again. In your own words, what does the 1% pathway mean?
Well, that is 99% eliminated along the way. That's what it means to me.
Because they're not willing to take action.
Whatever it is, 99% is eliminated, and the 1% is left.
Very good. Well, Selcuk, thank you so much for joining us on the podcast today and sharing your thoughts and experience about preferred returns, the truth and mystery behind them. Before we let you go, please tell our listeners where they can find out more about you and connect with you.
Yeah, they can reach me at fsexecutivepartners.com. It's stays somewhere in here, and I'm more on the LinkedIn and the Facebook. Selcuk Alemdar if they type that, and with my company's name and all that. So I'm available on those social medias.
Great. Yeah, I see you out there. We exchange some back and forth. Yeah. Well, thank you again, Selcuk. And for our listeners, if today gave you even one idea to help you move forward faster, please share this episode with someone in your network. That's how we help more people find the 1% pathway. This is Dennis McQueen signing off. I'll be back next week with another informative episode of the 1% Pathway podcast. Have a great day.
Thanks for having me.